Welcome to From Market Beginner to Professional Trader. This video series is designed for anyone who wants to understand the markets the right way, step by step. Before you risk real money, you need to build a strong foundation. You need to know what moves price, how to read the market, how to manage risk, and how to trade with a plan. We will start with the basics, then move into the economy, company research, chart reading, risk management, strategy building, and finally, a professional daily process. The goal is not to rush into trading. The goal is to build skill, discipline, patience, and confidence. By the end of this learning flow, students should understand how markets work, how to study opportunities, how to protect their capital, and how to think more like a professional trader. This is your roadmap from beginner to professional trader. Before anyone starts trading live, they need a strong foundation. The market is not just about buying and selling. It is about understanding what moves price, how investors think, how money flows, how charts speak, and how to protect yourself from risk. This learning flow is designed to take a brand new student step by step from the basics of the market all the way to a professional trading process. Each video will build on the last one, so students do not jump into trading without understanding the full picture. We will begin with market basics, where students learn what the stock market is, why it exists, how buyers and sellers move price, and how different markets like stocks, ETFs, options, futures, crypto, and bonds work. Next, we move into the economy, because markets are connected to interest rates, inflation, jobs, GDP, consumer spending, and central bank decisions. If students understand the economy, they will better understand why markets go up, down, or sideways. After that, we study fundamentals, where students learn how to research companies. This includes revenue, earnings, profit margins, debt, cash flow, valuation ratios, insider buying, earnings reports, and the quality of management. Then we move into chart reading, where students learn how price action works. Charts show the pressure between buyers and sellers. Students will learn candlesticks, support, resistance, trend lines, volume, and chart patterns. Once students understand charts, we go deeper into technical analysis. This section teaches indicators, moving averages, momentum, volatility, market structure, breakouts, reversals, and how to use tools like TradingView properly. Then comes one of the most important lessons: risk management. A trader can have a good strategy and still lose money without risk control. Students will learn position sizing, stop losses, take profits, risk to reward, drawdowns, and how to protect their capital. Next, we explain trading styles. Not every trader is the same. Some people are day traders, some are scalpers, swing traders, position traders, investors, options traders, or futures traders. Students will learn which style fits their personality, time, and risk level. After that, we introduce advanced tools such as options flow, dark pool data, market scanners, economic calendars, earnings transcripts, sector rotation, institutional activity, and news tools. Then we move into strategy build, where students learn how to put everything together into a trading plan. A strategy needs clear entry rules, exit rules, risk rules, market conditions, and a reason why the trade makes sense. Next is backtest and journal, where students learn how to test a strategy before risking real money. They will also learn how to track trades, review mistakes, measure performance, and improve over time. Finally, we end with the professional process. This is where students learn how serious traders prepare before the market opens, manage trades during the day, review after the close, control emotions, and follow a disciplined routine. The goal of this full course is simple. Students should learn what moves price, how to read price, and how to control risk before trading live. This flow gives them the knowledge, structure, and confidence to approach the markets the right way. 8. Welcome to Level 1, Market Basics. This is the first step in learning how the financial markets work. Before we talk about charts, indicators, strategies, or trading systems, students must first understand what they are actually buying and selling. In this level, we will keep everything simple. The goal is to help beginners understand the main products in the market: stocks, ETFs, indexes, bonds, options, and futures. A stock represents ownership in a company. When you buy a stock, you are buying a small piece of that business. An ETF is like a basket of investments. Instead of buying one company, an ETF can hold many stocks, bonds, sectors, or assets inside one product. An index is like a market scoreboard. It tracks a group of stocks and helps us understand whether the overall market is strong, weak, or moving sideways. A bond is a debt product. When someone buys a bond, they are usually lending money to a government or company in exchange for interest payments. Options and futures are contracts. They can give traders more leverage, but they also carry more risk, so students must understand them carefully before using them. In this lesson, we will also explain the basic language of the market: buyers, sellers, bids, asks, liquidity, spreads, and market hours. These are the building blocks every trader and investor must know. We will also talk about why prices move. Prices can move because of news, earnings, interest rates, fear, greed, expectations, and large institutional money. The market is always reacting to what people believe may happen next. The main goal of this level is simple. Students should understand what is being bought and sold before they ever place a trade. Once they understand the basics, they will be ready to move forward into the economy, fundamentals, chart reading, and risk management. Welcome to Level 2, Economy First. Before students analyze a stock, read a chart, or build a trading strategy, they must first understand the market environment. The economy is the background that affects almost every market: stocks, bonds, commodities, currencies, options, and futures. The main question in this lesson is the economy expanding, slowing, inflating, or weakening? That one question helps traders and investors understand what type of market they are dealing with. We will start with CPI and PCE inflation. These reports show how fast prices are rising for consumers. When inflation is high, the cost of living goes up, and the Federal Reserve may raise or keep interest rates high to slow the economy. Next, we look at PPI, which measures producer costs. This shows what businesses are paying for materials, labor, and production. If producer costs rise, companies may pass those costs to customers, which can keep inflation high. Then we study the jobs report. Employment tells us how strong the labor market is. A strong jobs market can mean consumers have income to spend, but if wage pressure is too high, it can also keep inflation elevated. We also look at GDP, which measures economic growth. GDP tells us whether the economy is expanding or slowing down. Strong GDP can support markets, while weak GDP can warn that businesses and consumers are under pressure. Finally, we study Fed rates, which represent the cost of money. Interest rates affect loans, mortgages, business investment, stock valuations, bond yields, and market confidence. When rates are high, money becomes more expensive. When rates are lower, money becomes easier to borrow and invest. This level teaches students that the market does not move in isolation. Price moves because investors are constantly reacting to inflation, interest rates, growth, jobs, and future expectations. The goal of this lesson is simple. Before entering any trade, students should understand the economic environment they are trading in. Welcome to Level 3, Company Research. In this lesson, students learn how to look deeper into a company before buying its stock. A stock can be popular, trending, or talked about on social media, but that does not always mean it is a strong business. The goal is to ask one important question. Is this a strong business or just a popular stock? We start with business quality. Students will learn how to look at revenue growth, earnings growth, profit margins, and cash flow. A strong company should not only bring in sales, but also turn those sales into real profit and cash. Next, we study valuation. Even a great company can be a bad investment if the price is too high. Students will learn basic valuation tools like the PE ratio, PEG ratio, market cap, and forward guidance. These help us understand whether a stock may be expensive, cheap, or fairly valued compared to its growth. Then we look at leadership and ownership. A company is only as strong as the people running it. Students will learn to check the CEO's track record, insider buying and selling, institutional ownership, and analyst changes. This helps us see whether management, big investors, and analysts are showing confidence or concern. This level teaches students not to buy a stock just because it is moving up or because everyone is talking about it. They must learn how to research the actual company behind the stock. The goal of this lesson is simple. Students should learn how to judge the strength, value, and leadership of a company before investing or trading its stock. Welcome to Level 4, Chart Reading. In this lesson, students learn how to read price on a chart. A chart is not just lines and candles. A chart shows the ongoing battle between buyers and sellers. Every candle tells a story about pressure, momentum, rejection, and control. The goal of this level is to help students understand what price is doing without guessing. We begin with trend. Price can move in an uptrend, downtrend, or sideways range. An uptrend shows buyers are in control. A downtrend shows sellers are in control. A sideways market shows indecision, where price is moving between support and resistance. Next, students learn support and resistance. Support is an area where buyers may step in and defend price. Resistance is an area where sellers may appear and push price back down. These levels help traders understand where price may react. Then we study breakouts and pullbacks. A breakout happens when price moves through an important level with strength. A pullback happens when price comes back to retest an area before possibly continuing the trend. Students must learn the difference between a real breakout and a fake move. After that, we focus on candlesticks. Candles show the open, high, low, and close of price. The body shows control. The wick shows rejection. A strong candle can show momentum, while a candle with long wicks can show hesitation or reversal pressure. Finally, we look at volume. Volume helps confirm or warn us about a move. If price breaks out with strong volume, the move may be more meaningful. If price moves with weak volume, traders should be more cautious. This level teaches students to slow down and read the chart properly. Before using indicators or taking trades, they must first understand trend levels, candles, and volume. The goal of this lesson is simple. Students should be able to describe what price is doing before they ever decide what trade to take. Welcome to Level 5, Technical Analysis. In this lesson, students learn how to use indicators the right way. Indicators should not be used to decorate a chart or make trading look complicated. Every indicator should answer a clear question. The most important rule in this level is price action comes first. Indicators confirm the story. We begin with trend indicators. These help students understand the direction of the market. Tools like the EMA, VWAP, PSR, Supertrend, and MEQD can help show whether price is moving up, moving down, or losing direction. Next, we study momentum indicators. Momentum tells us how strong or weak a move is. Tools like the RSI, MACD, ROC, and TTM squeeze can help students see whether buyers or sellers have power, or whether momentum is slowing down. Then we look at volume indicators. Volume shows participation. If price is moving with strong volume, the move may have more meaning. If price is moving with weak volume, students should be careful because the move may not have strong support behind it. After that, we study volatility. Volatility tells us how much price is expanding or compressing. Tools like ATR, expansion, and compression help students understand when the market is quiet, when it is starting to move, and when risk may be increasing. This level teaches students not to rely on one indicator alone. A good trader looks at the full picture: price action, trend, momentum, volume, and volatility. The goal of this lesson is simple. Students should learn how indicators confirm what price is already telling them, instead of blindly taking signals. Welcome to Level 6, Risk Management. This is one of the most important lessons in the entire market learning flow. Many beginners focus only on entries, indicators, and profits. But professional traders understand one thing first. Professionals survive first. Profits come second. Risk management is what keeps a trader in the game. A trader can have a good setup, but without a written plan, one bad trade can turn into a big loss. That is why before every trade, the plan must be clear. In this level, students will learn the key parts of a trade plan: entry, stop loss, take profit, position size, risk per trade, and invalidation. The entry is where the trade begins. This should not be random. Students must know why they are entering, what setup they are trading, and what confirmation they are using. The stop loss is the price where the trade idea is wrong. It protects the trader from letting a small loss become a large loss. The take profit is where the trader plans to collect gains. A trader should know the reward target before entering the trade. Position size decides how many shares, contracts, or units to trade. This is important because even a good setup can become dangerous if the trade size is too large. Risk per trade means deciding how much money the trader is willing to lose before entering. For example, risking $100 to try to make $200 gives a 1-2 risk to reward ratio. Invalidation means knowing what would prove the trade idea wrong. This keeps trading logical instead of emotional. This lesson teaches students that they do not need to win every trade. They need controlled losses and larger winners. A trader can still be successful with some losing trades if the risk is controlled and the winners are bigger than the losses. The goal of this level is simple. Before every trade, students must have the plan written down before risking real money. Welcome to Level 7, Know Your Trading Style. In this lesson, students learn that not every trader should trade the same way. A strategy must match the person using it. Some people are fast decision makers, while others need more time to think. Some people can watch the market all day, while others can only check charts after work. The main lesson is do not scalp with an investor mindset, and do not invest with a scalper mindset. We begin with the scalper. A scalper trades very short moves, usually within seconds or minutes. This style needs speed, focus, quick execution, and strong risk control. Scalpers are not trying to catch the whole move. They are trying to take small, fast profits. Next is the day trader. A day trader opens and closes trades within the same trading day. They focus on intraday momentum, key levels, news, volume, and price action. Day traders usually do not want to hold positions overnight. Then we study the swing trader. A swing trader holds trades for days or weeks. This style focuses on trends, pullbacks, breakouts, chart setups, and support and resistance. Swing trading gives more time to plan and does not require watching every candle. After that, we look at the position trader. A position trader holds for weeks or months. This style looks more at the bigger trend, macro environment, sector strength, and longer-term chart structure. Finally, we discuss the investor. An investor usually holds for months or years. This style focuses on business quality, earnings, valuation, leadership, and long-term growth. This level teaches students that the right trading style depends on personality, time, patience, risk tolerance, account size, and emotional control. The goal of this lesson is simple. Students should choose a trading style that fits their life and mindset before choosing a strategy. Welcome to Level 8, Advanced Products and Institutional Clues. In this lesson, students move beyond basic stocks and charts and begin learning the tools used by more serious traders. The goal is not to make trading complicated. The goal is to understand where larger money may be moving and how advanced products can affect price. The main question in this level is, where is big money going? We begin with options. Students will learn the basics of calls, puts, spreads, implied volatility, and the Greeks. Options can be used for speculation, hedging, income, and risk control, but they must be understood carefully because they can move very differently from stocks. Next, we study futures. Futures are contracts used to trade markets like the S&P 500, NASDAQ, oil, gold, and more. Students will learn about products like ES, NQ, and micros, along with margin, leverage, tick value, and contract risk. Then we look at options flow. Options flow shows unusual call and put activity, large premium trades, and possible institutional interest. It does not guarantee direction, but it can give clues about where traders are placing large bets. After that, we study the dark pool. Dark pool prints show large off-exchange trades. These trades can help students understand where big blocks of stock may be changing hands, but they must be used with context. Finally, we look at market breadth and the VIX. Breadth shows how many stocks are participating in a move. The VIX helps measure fear, uncertainty, and risk appetite in the market. Together, they help students understand whether the market move is healthy or weak underneath the surface. This level teaches students that advanced tools should support their analysis, not replace it. Options flow, dark pool data, futures, breadth, and volatility can all provide clues, but students must still combine them with price action, trend, fundamentals, and risk management. The goal of this lesson is simple. Students should learn how advanced products and institutional clues can help them understand where larger money may be moving. Welcome to Level 9, Build a Strategy. In this lesson, students learn how to turn market knowledge into a clear trading plan. A strategy should not be based on emotion, hope, or guessing. A real strategy is a rule-based process. The main lesson is, a strategy is a rule-based process, not a feeling. We begin with the market condition. Before taking a trade, students must know what type of market they are in. Is the market trending, ranging, breaking out, pulling back, volatile, or quiet? Different market conditions need different strategies. Next comes the setup. The setup is the situation the trader is looking for. For example, price may be in an uptrend and pulling back to support. A setup tells the trader, this is the type of opportunity I am waiting for. Then students learn the entry trigger. The entry trigger is the exact reason to enter the trade. This could be a bullish candle, volume confirmation, a break of a level, or a reversal signal. The trigger keeps the trader from entering too early. After that comes the stop loss. The stop loss is where the trade idea is wrong. It protects the trader from large losses and removes emotion from the decision. Then we plan the take profit. Students must know where they want to take profits before entering the trade. This could be the next resistance level, a fixed risk to reward target, or a trailing exit. Next is trade management. Once in the trade, students need rules for moving stops, taking partial profits, holding, or exiting early. Trade management helps avoid emotional decisions during the trade. Then we define the exit rule. A trade must have a clear reason to close. This could be hitting the target, hitting the stop, losing momentum, breaking structure, or reaching the end of the trading session. Finally, students need a no-trade rule. Sometimes the best trade is no trade. Students should know when to stay out, such as during major news, low volume, choppy markets, or when the setup is not clean. A simple example strategy could be uptrend, pullback to support, bullish candle with volume. Oh, stop below support, target 2R. This level teaches students how to build structure and discipline into their trading. The goal of this lesson is simple. Students should learn how to create a strategy with clear rules for when to enter, when to exit, when to manage risk, and when not to trade. Welcome to Level 10, Backtesting and Journaling. In this lesson, students learn how to prove whether a strategy actually works. A trading idea may look good on one chart, but that does not mean it is reliable. Before risking real money, students must test the strategy and review the results. The main lesson is, do not trust a strategy until it has been tested and reviewed. We begin with backtesting. Backtesting means going through past charts and testing the strategy trade by trade. Students should test at least 50 to 100 trades before judging the results. This gives them enough examples to see whether the strategy has real potential or only worked a few times by luck. Students will learn to track important numbers like win rate, average winner, average loser, drawdown, best time of day, and best market condition. These numbers help traders understand the strengths and weaknesses of the strategy. A strategy may have a low win rate but still make money if the winners are much bigger than the losers. Another strategy may win often but still lose money if the losses are too large. This is why students must look deeper than just wins and losses. Next, we study the trading journal. A journal is where traders record every trade they take. Students should write down the date, ticker, setup, entry, exit, profit or loss, screenshots, mistakes made, and lessons learned. The journal helps traders see patterns in their behavior. Maybe they lose more during news. Maybe they trade better in the morning. Maybe they enter too early or hold losers too long. Without a journal, these mistakes are easy to repeat. This level teaches students that testing turns an idea into evidence, and journaling turns experience into improvement. The goal of this lesson is simple. Students should learn how to test a strategy before using it live and how to review their trades so they can keep improving. Welcome to Level 11, Professional Daily Process. In this final level, students learn how professional traders prepare, execute, and review their trading day. A professional does not come into the market guessing. They follow a repeatable process every day. The professional rule is trade less, plan more, review every result. We begin with overnight futures. Futures can give traders an early clue about market direction before the regular market opens. Students will learn to check whether the market is strong, weak, flat, or reacting to news overnight. Next is the economic calendar. Before trading, students must know if major reports are coming out, such as CPI, PPI, PCE, jobs data, GDP, or Fed announcements. These events can create fast moves and higher risk. Then we look at major news. News about earnings, geopolitics, interest rates, company events, or global markets can affect sentiment and price movement. After that, students check the market trend. They need to know whether the overall market is bullish, bearish, or sideways. This helps them decide whether to be aggressive, cautious, or patient. Next is sector strength. Not all sectors move the same way. Some days technology is strong, other days energy, financials, healthcare, or defensive sectors may lead. Sector strength helps students find where money is flowing. Then students build a watch list. A watch list is a focused list of stocks, ETFs, futures, or option setups they are watching for the day. This keeps them from chasing random trades. Next, they mark key levels. These include support, resistance, pre-market highs and lows, previous day levels, moving averages, VWAP, supply and demand zones, and major breakout areas. Then comes the risk plan. Before the market opens, students should know how much they are willing to risk, where they will stop trading, and what conditions would make them stay out. After that, they review their trade setups. A professional trader knows what setup they are waiting for before the trade happens. They do not chase every candle. Finally, students complete an after-close review. At the end of the day, they review their trades, screenshots, mistakes, emotions, wins, losses, and lessons learned. This level teaches students that professional trading is not about taking more trades. It is about preparation, patience, discipline, and review. The goal of this lesson is simple. Students should build a daily routine they can repeat, improve, and trust before trading live. Welcome to the Complete Teaching Path. This is the full roadmap that takes a student from beginner level to a more professional market mindset. Each step is designed to build knowledge in the right order, so students do not jump into trading before they understand the foundation. We begin with understanding markets. Students first need to know what stocks, ETFs, indexes, bonds, options, and futures are. They must understand what is being bought and sold. Next, students understand the economy. The economy affects every market. Inflation, interest rates, jobs, GDP, and Fed decisions help explain why markets move. Then we move into researching companies. Students learn how to study business quality, earnings, revenue growth, valuation, leadership, and ownership before buying a stock. After that, students learn to read charts. Charts show the battle between buyers and sellers. Students learn trends, support, resistance, candles, volume, breakouts, and pullbacks. Then we teach students how to use indicators properly. Indicators should confirm the story, not replace price action. They help with trend, momentum, volume, and volatility. The next step is to control risk. This is where students learn stop losses, position sizing, risk to reward, take profits, and trade invalidation. Risk control is what keeps traders alive. Then students choose their trading style. A scalper, day trader, swing trader, position trader, and investor all need different plans. The strategy must match the person. After that, students learn to use advanced tools like options, futures, options flow, dark pool data, breadth, and VIX. These tools help answer where bigger money may be moving. Then students build and test a strategy. A real strategy has rules for market condition, setup, entry, stop loss, take profit, trade management, exit, and no trade zones. Finally, students learn to trade with a plan. A professional trader prepares before the market opens, follows rules during the day, and reviews every result after the close. The message of this full teaching path is simple. Markets reward preparation, patience, discipline, and risk control.